All right, let's clear the board. Forget everything you think you know about telcos. If you're looking at this sector and seeing, dividend yields and boring utility-like behavior, you are missing the single biggest capital cycle shift in, well, the last decade. We are not talking about a phone company today. We are talking about a monster hiding in plain sight, a company that is trading like a utility, but operating with the margin profile and the technological leverage of a big tech infrastructure player.
It's deceptive, isn't it? On the surface, it looks like SIM cards and data plans, but if you actually go into the engineering labs, if you go to Bellevue and look at what's happening under the hood, it feels more like a semiconductor fab than a carrier.
Really? A fab?
Yeah, the heat, the urgency. It's not about maintaining phone lines anymore. It's about building software-defined infrastructure. I've been digging into the architecture, and honestly, the market has absolutely no clue what this machine is actually capable of.
That's exactly why we're doing this deep dive on T-Mobile US, ticker TMUS. Because as an investor, I look for one thing: mispricing based on a misunderstanding of the business model. The market, it thinks this is a dividend stock. But when I look at the capital flows, I see a growth engine that has just finished building a massive factory and is about to turn on the printing press. We need to figure out if T-Mobile has reached what I call a structural inflection point.
Right. The fundamental equation is changing. We are moving from a cycle of heavy capex, pouring concrete and climbing towers, to a cycle of massive cash harvesting. And the catalyst isn't marketing. It's physics. It's the network architecture itself.
Okay, hold on. Let's unpack this physics argument before we get too excited about the money. Because usually when people talk about T-Mobile, they talk about the uncarrier marketing, the pink shirts, the aggressive ads. But you're saying the real moat isn't the brand, it's the dirt, or rather the spectrum.
It's the highway. Let's use an analogy that really fits what I saw in the technical specs. Imagine Verizon and AT&T are currently driving on dirt roads, maybe gravel. And they are trying to pave these roads while they are driving on them at 60 miles an hour. They are spending billions at auctions just to buy the gravel to fill the potholes.
And that's the C-band auctions, right? I mean, Verizon spent something like, $60+ billion just to catch up?
60+ billion, exactly. That's the cost of paving the road. Now, look at T-Mobile. Thanks to the Sprint acquisition, which historically will go down as one of the greatest arbitrage plays in telecom history, they didn't just buy gravel. They bought a pre-built 10-lane superhighway. That 2.5 gigahertz spectrum is a massive, contiguous pipe. While competitors are digging trenches, T-Mobile is already driving Ferraris on a finished road.
So this is the cost moat. They acquire the capacity for pennies on the dollar compared to what competitors paid at auction. That shows up directly in the free cash flow because they aren't servicing the debt of a massive auction spend.
Correct. But here is the technical nuance that most analysts miss. It's not just about the width of the road. It's about the engine of the car. We need to talk about 5G standalone versus non-standalone.
Okay, let's decode that. 5G SA versus NSA. I see these acronyms in the footnotes, but in plain English, why does that matter to the bottom line?
Think of 5G non-standalone, which is what most of the competition relies on as a hybrid car. You have an electric motor, sure, but you're still lugging around a heavy combustion engine, the legacy 4G core. You can't go full speed, and you can't do the really advanced maneuvering.
Okay.
T-Mobile is running 5G standalone. It's a full EV, no gas engine, no legacy 4G anchor.
So they have a pure electric fleet on a 10-lane highway, while the other guys are driving hybrids on a construction site.
That is the perfect way to visualize it. And the heat I mentioned in the labs, it's because the engineering teams know they have this lead. They aren't just maintaining a network. They are optimizing a software-defined environment. Because they are on standalone architecture, they can do things with software that the other guys simply cannot do because they are tethered to the old 4G hardware.
And this leads us to the monetization problem. Because I'm looking at the sector and I see price wars. If everyone has 5G, isn't speed just a commodity? If I can stream Netflix on Verizon or T-Mobile, why do I care? How does T-Mobile turn this EV on a superhighway into actual profit margin?
This is where the deep tech aspect kicks in. The game changer is network slicing.
Slicing. Okay, break it down. I've heard the pitch, but I haven't seen the cash.
Go back to our highway. On a normal highway, an ambulance is stuck in the same traffic as a minivan. But with network slicing, which is only possible on that standalone 5G architecture, T-Mobile can digitally erect concrete barriers in milliseconds. They can designate lane 1 exclusively for ultra-low latency. That's your ambulance lane. Or your autonomous robot lane.
So they can guarantee performance.
Exactly. And then lane 10, that's the cargo lane. Massive data dumps for logistics companies. They can slice the network based on the specific needs of the customer.
This is the B2B pivot. I've seen the targets. They want, a 25% market share in enterprise?
It's the only way they get there. Think about a smart factory. You have robots moving materials at high speeds. If the network lags for 10 milliseconds, 2 robots collide. That's millions in damage. A factory manager doesn't care about fast download speeds. They care about zero lag. T-Mobile can sell them a guaranteed slice of the network that ensures those robots never crash.
And here's the financial kicker. Since the highway is already built, selling that slice costs T-Mobile almost nothing in incremental capex. It's pure margin.
Precisely. B2B margins are structurally higher. We're talking 5 to 10% higher than consumer plans because the infrastructure is shared. You are monetizing the same asset twice. Once for the teenager watching TikTok in the passenger seat, and again at a premium for the autonomous car driving him.
Okay, I want to zoom out because we've talked about the road and the cars. But looking at the recent news flow, there are these disparate pieces of the puzzle that don't seem to fit together at first glance.
You mean the partnerships?
Yeah, you've got this deal with SpaceX for Starlink. Then you have the acquisition of U.S. Cellular, which is basically rural towers. Then you have these joint ventures for fiber with Lunos and Metronet. And finally, this collaboration with OpenAI on something called IntentCX.
Right. To the average observer, that looks like a shopping list. A bit of this, a bit of that.
It looks like a conglomerate trying to find growth,
But
but do you see a pattern here?
I see a grand architecture.
Yeah.
Let's connect the dots. Start with SpaceX. What does that give you?
Direct as cell. It covers the sky. Dead zones are gone.
Right. It covers the sky. Now, U.S. Cellular. What is that?
Rural ground. Farmland. It boosts their coverage footprint by something like 30% in those hard-to-reach areas.
Okay, sky and ground. Now, the fiber JVs, Lumos and Metronet.
That's the home, the wired connection.
Exactly. And finally, OpenAI and IntentCX.
That is the brain managing the traffic. Wait, hold on. So if I'm a logistics company, or better yet, if I'm running an AI logistics fleet across America, I need the sky, the ground, the wired connection, and the brain to manage it all.
You need a contiguous, gap-free, intelligent fabric.
This isn't a phone company.
It's not.
They control the entire neural network of the AI era. If you are Tesla or Amazon or any company deploying AI in the real world, you cannot have dead zone. You cannot have latency. T-Mobile is building the only platform that connects the satellite to the tower to the fiber processed by an AI brain.
That's the epiphany. Smartphones are just one endpoint. They are just the glowing rectangle we hold. But the real value is owning the intelligent pipe that connects everything else. The barriers to entry here are, they're astronomical. You can't just build another satellite network and nationwide 5G grid overnight.
That is terrifyingly brilliant. It's a monopoly on connectivity, disguised as a competitive carrier. Okay, let's bring this back to the numbers, because as an investor, I need to know, does this neural network actually print money? Or is it a science project?
Oh, it prints. We are entering the harvesting season.
I love that phrase, harvesting season. It implies the hard work is done.
The massive capex cycle, the billions spent building that 10-lane highway is winding down. The network is built. Now, every dollar of revenue flows faster to the bottom line. Look at the free cash flow projections.
I'm looking at what, $18 billion projected for 2025?
$18 billion, and look at what they are doing with it. They aren't burning it on stupid acquisitions.
They have a $14.6 billion shareholder return program, buybacks and dividends.
Yep.
That is massive. That's yield plus growth.
And the EBIT to target is around $37 billion for 2026. But here is the structural change you asked about. The business model is shifting from spending to grow to optimizing for profit.
This is the inflection point, when a company stops building the factory and starts running the factory at full capacity. But there's a detail in the consumer data I found fascinating, the self-selection.
Oh, this is huge.
Usually in a recession or high inflation environment, you see customers trading down, cut my bill, give me the cheap plan. But T-Mobile is seeing the opposite. Customers are voluntarily choosing the higher price plans, like Experience Beyond.
Because of the bundles, Netflix, Apple TV, plus T-Mobile has aggregated the digital life into the phone bill.
It's driving organic ARPA average revenue per account growth of 4%. In this economy, that's pricing power. That is not a utility. That is a brand with leverage.
And it connects back to the tech. If you have the best 5G experience, people pay for the premium plan to use it. It's a virtuous cycle.
Let's talk about the efficiency side. You mentioned the brain IntentCX. You called it precognitive. That sounds a bit sci-fi. Is this just a fancy chatbot?
It is absolutely not a chatbot. A chatbot waits for you to complain and then reads a script. IntentCX, built with OpenAI, looks at the network data in real time. It sees that your call dropped 3 times in the last hour. It sees that you are in a specific location.
Oh, it knows I'm having a problem before I even call.
Before you even pick up the phone. It might send you a push notification saying, "We noticed a signal issue in your area, we've reset your connection, and we're crediting your account $5.
Wow.
It solves the problem before it becomes a complaint. The data shows 50% of customer intent is addressed automatically.
That decimates the SG&A line, selling, general, and administrative expenses. If you don't need call centers because the AI fixes the problem, your margins explode.
Exactly. And look at the digital upgrades. 75% of iPhone upgrades are now contactless. No store visit, no commission paid to a sales rep.
This is how they maintain tech-like margins in a telco business. They are automating the human friction out of the system.
And the result? Churn the cancellation rate is incredibly low, less than 0.9%. It creates the sticky ecosystem, the magenta lock-in. Once you have the best network, the bundled Netflix, and an AI that fixes your problems, why would you leave?
You wouldn't. But I'm a hedge fund manager. It is my job to be paranoid. It can't be all sunshine and rainbows. There are risks here.
Of course.
First off, the CEO change. Mike Sievert was a marketing genius. He was the face of the uncarrier. Now we have new CEO coming in, Srini Gopalan. T-Mobile's entire edge was that they were the cool carrier. Does a German telecom exec kill the vibe?
That's a valid fear. But if you look at Srini's background, he is a tech and numbers expert. Remember the phase we are in, harvesting, optimization. You don't need a marketing cheerleader right now. You need an operator who can squeeze every ounce of efficiency out of that neural network. Srini is exactly the general you want for this specific phase of the war.
Okay, fair point. The general for the harvest. What about U.S. Cellular? Mergers are messy. Integrating networks is a nightmare. Historically, these things drag down earnings for years.
That's the consensus view. Mergers are hard, but look at the data. The estimated synergies are $1.2 billion, and T-Mobile says they can realize that within 2 years. That is incredibly fast.
Why so fast?
Because of the spectrum depth I mentioned earlier, T-Mobile has so much capacity on their 10-lane highway that they can absorb UCellular's customers without having to build new towers. They just migrate the traffic. It's like opening a toll booth. The road is already there.
So the integration risk is mitigated by the excess capacity they already own. That makes sense. And speaking of financials, I found a hidden gem in the footnotes, a little Easter egg for the balance sheet nerds.
The tax shield.
Tax shield.
Yeah.
Because of the legacy losses from the Sprint merger and other items, they're expecting about $1.5 billion in tax benefits in 2026.
That is pure cash flow.
It goes straight to the SCF line. It's $1.5 billion that doesn't go to Uncle Sam, it goes to share buybacks. That is a massive tailwind that I think the market is underappreciating.
It's just another layer of the cost moat.
So let's wrap this up. We started this deep dive asking if T-Mobile is a boring utility or a growth engine.
I think the answer is clear. We went from the uncarrier, which was a price disruptor, to the AI native platform, which is a value disruptor.
The market is slowly waking up to this. You can see it in the valuation re-rating. Investors are starting to realize, hey, this isn't a stock I buy for a 4% yield and 1% growth. This is a cash-generating tech platform that just happens to cell phone plans.
The structural inflection point is real. The fundamental equation has changed.
And when you combine the harvesting of cash with the neural network of the future, you get something that looks very different from AT&T or Verizon.
It raises a provocative question, doesn't it? If T-Mobile owns the sky with SpaceX, the ground with their 5G SA, the home with fiber, and the brain with their AI, are we even looking at a telecom company anymore? Or are we looking at the world's largest distributed computer?
A distributed computer that fits in your pocket. I'm going to be looking at the signal bars on my phone a little differently today.
Just remember, there's an AI watching those signal bars before you even notice them.
That's comforting. It's slightly terrifying. Thanks for listening to The Deep Dive. We'll catch you on the next one.